The double EMA indicator can be a very useful tool to have in your trading arsenal because it can help you to spot a strong momentum as well as the outstanding trading opportunities. So that's why in today's video you will learn everything there is need to know about the double EMA and how to use it to pull out the profits of the market. So let's get started. Most traders are already familiar with the most commonly used moving averages such as the simple moving average and the exponential moving average. However, if you trade in Forex or stocks, the double exponential moving average may be worth considering looking at if you want to trade with more precision and less lag. But what it is about the double EMA that makes it so important that other moving averages lack it? When compared to a standard exponential moving average, the double EMA indicator is actually more responsive to recent price data on the chart, making it more popular tool among the day traders and swing traders. And if you probably know, moving averages are typically viewed as lagging indicators. They may provide trading signals that are sometimes inaccurate. So in contrast, the DEMA removes those false signals and refines entries during strong trends because of how it reacts to price movement, and that's resulting in greater probability during that momentum. As previously stated, the double EMA indicator is more sensitive to recent price changes than moving average indicator. As a result, it may commonly reveal signals beforehand than the majority of other moving averages analysis, which may be beneficial to us traders. So in my opinion, the indicator itself appears to be very promising, but the question is how we can use it in our trading in order to obtain that level of accuracy and less lag result. So here are the some of the most significant double exponential moving average indicator applications you should be aware of. As you know, identifying trends is a critical component of trading. It will be hard to consistently outperform the market if you do not understand the current market circumstances. So it is critical for the traders to have an effective method for assessing whether the market is moving up or down, and it is possible to see the market's overall trend by looking at the price chart, but you do want to have a more objective way of determining the current trend. And that's why the double EMA moving average line performs a fantastic job of representing that information. So whenever the price is trading above the DEMA line and the DEMA line is rising higher, we may conclude that the trend is upward. On the other hand, if the price is trading below the DEMA line and the DEMA line is heading bearish, we may establish that the trend is downward. So the second way you can use the DEMA indicator is to actually plot your support and resistance levels. As a result, there are several approaches to identify support and resistance in the market, but the two most common forms of support and resistance levels are fixed support and resistance and dynamic support and resistance levels. So here is an excellent illustration of the differences between the dynamic and fixed support and resistance levels. We know about support and resistance as horizontal lines or diagonal trend lines, but dynamic support and resistance are totally different. The main difference is dynamic support and resistance levels are constantly changing and moving with the price. So to make things clear, the double EMA indicator can be quite useful in finding levels of support within an uptrend or resistance within a downtrend. So here is a great tip to remember the difference between these two. The fixed support or resistance levels aren't moving and they are horizontal, but dynamic support or resistance levels are moving alongside with the price, but they are not horizontal. In my opinion and in my overall experience with a double EMA, it can also be used as an entry or exit signal when trading, and as a result, most day or swing traders choose to use two DEMA indicators to highlight it. So one of the most straightforward methods would be just wait for the price crossover to the upside of the DEMA line from below in order to signal a long entry, and in the same sense you may wait for the price crossover to the downside of the DEMA line from above to suggest a short entry into the market. And you know, using a double exponential moving average is relatively easy. For the most part, I like to combine a shorter double EMA with a longer term EMA. So for example, I would use 21 DEMA as well as 50 DEMA. When using this type of indicator in your strategy, the goal is to find an area where the two lines cross each other and find reversals. So for this to happen, the price needs to be either moving upwards or downwards, because we simply want to go along with the market and take the maximum pip volume out of it. Of course, do not forget the correct risk management and do your own analysis. So here's an example of your potential sell scenario using the DEMA indicator. I just forgot to mention, but as you can see, the moving averages, this double moving average indicator, as I said, it reacts more sensitive. That's why it's so close to the candlesticks. But as you can see, I do have AUD USD on a 4-hour chart. As an example, we can see a nice uptrend making higher highs, and the price has also been respected 21 DMA, which again indicates the bullish power for now. However, a developing M pattern on a higher time frame most of the time indicates a potential shift in a trend, and sometimes even the smallest things such as this spinning top candlestick pattern can confirm it. So later on, as you can see, we do have a bearish engulfing candle that was developed, which again bounced off the 21 DMA to say, okay, bulls, enough, the bearish power is coming into the market, and this is a potential early sell opportunity, which resulted a profitable trade, because as you can see, the 21 DMA line crossed the 50 DMA line, which is another great indication that we should go for a short trade opportunity. And apart from using indicators only, this cannot be done alone. As you know, the top-down analysis is very important when it comes to trading. I also encourage you to use the bar chart. They do have a legacy report where it basically shows the numbers of what the hedge fund is doing, and you can definitely see what to do with the currency pair you're willing to trade. Of course, you can use an economic calendar to see if there's any potential events coming up that can influence your currency pair. So don't forget these small things that can have a big influence on your trading. And if you enjoyed this video, make sure you watch this video next, because it's going to tell you how to make more stable profits in an excellent way.